literally this week, there were huge new laws that are coming down the pipeline from the SEC. And I say that it's coming down the pipeline. These rules have already been passed, and I'll talk about them in a second. But if you're doing a private investment fund, the same ones we just talked about, now within the next 18 months, if you got $1.5 billion or less that you're managing, you have 18 months to come into compliance. All of a sudden now you're going to have to start doing quarterly statements, letting all of the investors in these funds know how the fund is doing. What's the performance? What fees are the management actually charging? And what other expenses are being charged to the fund itself? This is a massive difference from what's been going on in the past, which has been a much more opaque. It's tough to know exactly what a hedge fund is doing. They're kind of operating behind the scenes. And so it is a massive, massive change of the SEC to say, no, we actually want you to be fully transparent. What you're investing in, less so, but how the investments are doing, what fees the management are charging, and what expenses are coming up. With the second major difference are now all of these private funds will have to have annual audited financials. That's going to be a major hurdle for starting a private equity fund and growing a private equity fund, only because it tends to cost a good bit of money to get audited financials. So actually don't plan on just doing $1 million or $2 million in these funds nowadays. And that's okay as you're ramping up. Everybody starts somewhere. But you have to be targeting the $5, $10, $15 million funds for financially for the cost benefit of all of this to make sense. For your investors, this is about providing them the transparency. Also providing to the investors the reliability of what you're reporting is actually true. So these changes are very much so in the favor of the investors. But across the board, there's going to be more compliance that's going to be required for all of these private equity hedge fund type funds. The last change that's coming down the road are there's going to not be any side letter agreements permitted. Now, you ask me, I think the side letter agreements should have always been illegal. We advise all of our clients to never do that. But just to explain what a side letter agreement is, if you're a large investor that's coming into a fund or a syndication or investment, oftentimes you want some special treatment. You want to think that you are, different than everybody else, generally because you're investing a larger sum of money. I know, I understand. I encourage our clients to never do these side letter agreements. However, because usually you don't disclose to the investors what you're doing. You're taking out of the management side to treat an investor like they're special. It's happened all the time. In my opinion, the easiest things to do is, if you're going to be a big investor, you're going to invest that $10 to $15 million. Great, fantastic. Create a special class and open it up to anybody that wants to meet this high investment amount and give everybody the opportunity to invest in that deal. So I did want to really cover this because it is literally brand new information that is just coming together. But I actually know to a huge extent, you and anybody that is looking at organizing a fund is paying attention to real estate. And I need to tell you that everything that I talked about doesn't apply to real estate funds, except for the real estate, private equity fund. We'll talk about that. But I don't want to scare you. The audited financials and all of those, You really don't need to worry about that as long as you're focused on real estate.